Hey folks, how's it going? I can see four of you are in here now, so I will be getting started in just a sec. So just bear with me while we wait for a few more folks to come in, and then we will go live and crack on from there. Okay, 8 people. Well, hopefully everyone can hear me okay. Okay. Sorry, I'm just opening up the live stream on my phone to make sure that it's actually working. So listen, to people who are here, I can't actually see who's in the room, but thank you, Mathieu, for being the first person to post something to let me know that I'm not screaming into the endless void of the internet. Um, so let's give it a minute or two more, see if a few more people come along, and then we will crack on. I've got a presentation that I will share, which is about 30 minutes or thereabouts, and then we'll have a bunch of time for Q&A at the end. The Q&A, if you wouldn't mind, and I'll kind of keep hitting on this. Hey, Ant, how are you? If you want to put questions in the live chat on the sides, when I finish the presentation, I'll come back and go through the questions kind of one by one. I'm not very sophisticated streamer just yet, so haven't quite figured out how to do that while I'm actually streaming live as well. So let's give it, we've been live for 2 minutes, let's give it about 30 or 40 more seconds, and then I'll crack on. The first slide is basically me introducing myself anyway, so there's nothing too exciting to show there. And yes, thank you, Matthew. It is better to have some feedback. We did some stuff for Techstars before where I think I was in the waiting room talking for about 20 minutes before someone told me that the stream wasn't live. So it's good to know that it is actually working this time around. So welcome to my office. You can see my guitars here in the background. And I think three minutes is long enough to wait for people, isn't it? I will start to share my screen, and then we will crack on with things. So. Okay, so you can now see these slides. Yes, you can, and I can see this on my phone, so I know it's actually working. So I'm going to talk today a little bit about VC math. And before I do, I just want to share a little bit of the kind of thinking behind this stream. So this is a presentation I gave at a Techstars program a couple of months ago off the back of some conversations I'd had with founders who were thinking about raising money or thinking about coming and talking to angels and VCs. And when you would say no, or it's not a fit, or you're not ready, or anything else, they would, get pissed off. And actually, in a lot of cases, the reason that they got annoyed is that they didn't really understand what the motivating factors are for us making investment decisions and the kind of simple mathematical equations that we run in our own heads that help us decide whether this is a VC backable business or not. So I'm going to share a bunch of slides that kind of explain that thinking a little bit, or hopefully at least give you kind of some insight into it. And then, as I say, we'll have lots and lots of time for Q&A. You can feel free to pop questions into the live chat. So I've got the chat open on my phone here next to me, so I'll be able to answer them in real time as well if you would like. But having said all of that, I will crack on. If you hear shouting and screaming in the background, my son is currently going to bed, so he's not always an enthusiastic participant in that process. So if you hear some background noise, it's just him. We're not running some sketchy torture chamber here. So for those of you who don't know me, my name is Eamonn Carey. I'm a founder and an investor. So I've had a couple of companies that were fortunate enough to be successful. One that was a car crash or learning experience, as I prefer to think about it now. I wrote my first book a couple of years ago. The second edition of it is coming out soon, The Startup Lexicon. You'll be able to buy it on Amazon and a bunch of other places. There's a my first typo, this is embarrassing. I'm an investor in over 100 companies, not in over 10 companies. So I've invested in a lot of businesses around the world. I'm currently general partner at Terra Ventures. So we're a pre-seed and seed stage fund focused on the Nordics, Baltics, and Central Eastern Europe, and also a partner at the fund, also known as Everywhere Ventures. As the name suggests, we invest everywhere else. I ran Techstars both in New York and in London, and worked on lots of their other programs for many years, from 2015 to 2022. I'm still involved there as a mentor and helping out in a bunch of different ways. And if we ever meet in person and you want me to be your best friend, then point me towards the nearest karaoke bar. So let's now talk about venture capital, which is a greasy journey. So venture capital actually came about many years ago in the kind of 1800s. At least the concepts behind it came about then. Hopefully, some of you have read this book. But Moby Dick it's a whaling ship. Obviously, Ahab enthusiastically pursuing one particular whale rather than trying to gather as many of them as possible for blubber and beyond. But basically, the people who organized these whaling journeys, these whaling agents, they were effectively like VC funds. And actually, some of the words that we use, the carry, et cetera, come directly from this period of time. So the people who were going out on these whaling journeys raised their money from wealthy individuals, from what we think about as family offices nowadays, as well as kind of a wider pool of investors. And they financed the journeys of these boats. And the way that the people on the boats got paid was in what they called carry, right? So if you were a first mate or a deckhand or anything else on any of these boats, the way that you got paid was not a salary. You got a portion of the carry that boat brought back, so a portion of the profits that boat generated. So that's kind of a potted history of VC. In essence, venture capital is an asset class that is focused on very early stage businesses, particularly startups. It's a very high risk investment because lots of companies don't work out. We'll dig into some of those numbers over the next little while as well. Hi, Keith. Greetings from Galway. Hopefully the buzz is starting to build before Sunday. I'm actually quite jealous that I'm not there at the moment. A friend of mine is running an evening in Taft prepping for the All-Ireland final. So that will be fun. But back to VC. So there's a big failure rate with startups compared to if you invest in Apple or Tesla or any other publicly traded asset. There's a reasonable expectation that those companies will continue to exist in a year, 2 years, 5 years, 10 years. With VC-backed companies, there's a better than average chance that company won't exist in two or 3 years. And so venture capital is generally deployed via funds. So they pool capital from what's called LPs, which we'll talk about in a couple of minutes. And then the partners and the team invest in companies, right, in startups. In my case, particularly kind of idea, pre-seed stage and seed stage startups. The business became wildly profitable, and a huge amount of interest grew in the venture capital business primarily because of this guy. So this is a guy called George Doriot. He was a director of the US Army's planning division in the Second World War. He was a teacher at Harvard Business School, and just after the war, he started a company called ARDC, so the American Research and Development Corporations. For a reason that we'll get into now in a minute, he became very famous and produced the kind of returns that most VC funds can only dream of. He also founded INSEAD. If any of you are MBAs or aspiring MBAs, he's involved there. But basically, his fund ARDC, they invested in a company called Digital Equipment Corporation in 1957. So they invested $70,000 at that time. That company then went and IPO'd about 10 years later for $38 million. So it was a 500x return. And they retained actually some shares in that company until the company continued to grow and grow and grow. So they made an enormous return. And people started to see from this point on, hey, there is money to be made investing in early stage companies, backing them at the riskiest stage of the business, acquiring a reasonable stake in return for the risk that we're taking, and then hopefully being able to sell that stake when the company is either acquired or goes public. And when you see, if you think about turning, £1 into £500, that's quite a nice thing to do. If you think about that multiplied out over 70,000 up to 38 million, that's a very good way to do it. And there was you may have seen it, those of you who are on Twitter or Instagram recently, the first people who put money into Uber, there was a small round that was put together, and like if you put $5,000 into Uber's first round, that turned into 25 million when they IPO'd. So it just goes to show you the kind of scale of the return that you can see from businesses when they get to scale. And so this is kind of where VC started to become popular. And obviously now it's this enormous industry around the world. The challenge for VC is actually, there's only a few funds that do very well, right? So the top 6% of funds in the world deliver about 60% of the money back to investors. The top 25% of funds are by far the best performing. And the sad truth about VC, and this hopefully bursts the bubble that some people have of like, oh, VCs are amazing and they're great and they know all of this stuff, is like most funds don't return all of the money that they get from investors back to those investors, right? Half of VC funds return less than 1x of the money that they raise. The kind of baseline rule that investors in VC funds want is that they want about a 3x return. So every million they invest, they want to see 3 million return to them. As you can see here, it is an extraordinarily small number of funds per year, or funds in aggregate, that actually deliver that type of return. So it is a high risk industry. It is a high risk area for people to put their money into, and you can see this kind of power law concentration, not just in VCs but in startups as well. So let me tell you how it works, right? So as I say, VC potentially quite lucrative, but the kind of devil is in the detail in all of these things. And for folks who've just joined, I see a few new people. Hi, I'm Eamonn. Thank you for coming along. If you have any questions, feel free to just pop them in the live chat. I'll try and answer as many as I can in running, and then, as I said, we'll have some time for Q&A at the end. But VC effectively is funded by limited partners, right? So VCs have investors as well. And this was the bit that I never fully thought about when I was a founder. Because when you go and pitch a VC as a founder, it's my job to give out money, right? I have a limited amount of time in which to invest the capital that the fund has. These limited partners, they're family businesses, they are pension funds, they are super rich people. They don't have to give you their money. They don't have an obligation to do any of those things. So it's a tough business pitching them as well. But generally, the LPs in VC funds are other founders of companies who've been successful, operators of companies, high net worth individuals, family offices, so wealthy families or family businesses, pension funds, more so in the US. Pension funds are quite active investors in funds in the US. It's not so much the case here. You get a lot of corporates who are LPs in funds. So, for example, in Terra Ventures, we have Itochu, who are one of the largest Japanese conglomerates, are an LP in our fund. Mistletoe, who are another conglomerate in the Japanese market, are investors, and Puro Jane, who are a big family office and corporate in Texas, involved in property and healthcare and much more besides aviation, etc. They're also fund of funds, so funds that exist to invest in VC funds or private equity funds. So, they are looking for a good return on their investment, somewhere in the range of kind of 10 to 12% per year. So aiming for kind of a 3x return on the money that they put into a business. For most of these funds or pension funds or family offices, venture capital is a tiny percentage of their overall allocation. So they might have 1 or 2% of their total wealth or assets under management going into venture. The rest will be in private equity or commercial real estate, residential real estate, debt financing, et cetera, et cetera. So they put money in, and then the fund operates on this structure. It's called a 2 and 20 structure. So you get a fund, the fund exists for 10 years, and then you can get what's called an extension, which is you get to run the fund for another year. Typically you get 2 extensions. So fund life cycles generally are about 12 years. And that means that the fund kind of starts and ends within a fixed period of time. Like in most cases, funds will shut down after 10, 12, in maximum maybe 15 years. And we'll talk about why that's important in a couple of minutes. They have what's called an investment period, which is kind of 2 or 3 up to maximum 5 years. And so that's where they do all their initial investments, right? So what's called primary investing. So the first ticket into companies. Funds will, in some cases, reserve no money from their fund, in some cases up to 50% of their fund, to then do follow-on investment. So the deal that they do in year one, they might do a follow-on check 2 years later, and then they'll do a Series A ticket, 5 years later. So the investment period is just for those first checks, and when that investment period is finished, they can only do follow-on investments in the businesses that they've invested in. That's important because if you were talking to a VC fund that raised their last fund in, 2018, they probably don't have any money to give you, right? Unless they've raised a new fund that they haven't announced yet, which is unlikely, they're not going to have any capital to give you. So it's one of those things where if you're talking to funds, it's always worth looking at Crunchbase or PitchBook or others to see when they raised or ideally closed their last fund, because that will give you a picture for how much money they're likely to have left, if any, to invest. If they just closed their fund 2 weeks ago, then great, they'll generally have money. As I say, if it was 4.5 years ago, it's a little bit less likely that they will have it. The way VCs make most of their money is they charge a management fee. So they charge between 2 and in some cases up to 3% for that investment period. So if it's a 50 million euro fund, they will charge €1 million a year to manage the fund and invest it. And so that pays for salaries, that pays for offices, it pays for travel, it pays for legal fees, it pays for all of the kind of accounting fees, audit fees, etc., that funds incur. And then once that kind of investing period into businesses is finished, that that management fee drops down to 1% usually, right? And so which is why funds have an incentive to raise a fund every 2 or 3 years, which we'll talk about a little bit later as well, because obviously once the investment period has finished and their income has been cut by half, then they have a heavy incentive to raise more capital and start paying themselves some more management fee again. Funds generally have a hurdle, right? So investors who put in their money before any of the VCs start taking out their profits, they have to cross this hurdle, which is returning at least 1.2x of the money. And then investors get to start taking what's called carry, which we'll talk about in a sec. Most funds also have what's called a GP commit. So VC in particular, you don't see this all the time in private equity, but VC funds, a person who is a general partner in a fund is also an investor in that fund. So again, a 50 million fund, there will be a GP commit of 2%, which means that the partners in that fund are putting in £1 million or euros or dollars of the investment into that fund. So I see founders occasionally kind of joking about like, oh yeah, you're like investing a whole bunch of other people's money, and yes, a lot of it is other people's money, but in most funds, it's also the investors' own money, so they're putting some of that at risk. But the ultimate reason, the real reason that people see the huge upside in VC is the carry, right? And this goes back to the whaling story from earlier on, right? So once you have returned the fund and gotten over your hurdle, the profits that fund generates, the partners, the VC fund takes 20% of that. So if you have a 100 million fund that returns $1 billion, right? You have, let's call it roughly 900 million of profit that's been generated by that fund, and you would get, obviously a happy payday for the investors in the range of 180 million, right? So the carry is the real draw for VC investors, and that's why they look for these outsized returns that we'll talk about a little bit later on. But that is kind of the economics of most VC funds. So they charge us 2% management fee, which drops to 1% after this investment period is over. Most VC funds last for about 10 to 12 years. We can go into why a lot of people are saying, actually, this investment period should be, or this management period should be longer, but that's a more esoteric conversation. But the real juice in the VC market, as it were, the real reason you want to get to a 3x or 4x or a 10x fund is obviously if you return, even if you return $50 million in profit to your limited partners, you're getting 10 million of that to distribute between the various different stakeholders in your fund. And the stakeholders in your fund look a little bit like this, right? So there are partners or MDs. Generally, as I say, general partners are the people where some of their own money is at stake in the fund. They are kind of at least in theory, a strategic role. So leading on sourcing, the people who bring companies to an investment committee, who do a lot of the digging into businesses, who will eventually take board seats at these companies and support them after the investment is made. You have venture partners, and there are different types of partners. So general partners, I say, that's someone who's put their own money into the fund. You can have partners. Those are people who still obviously have decision-making powers. They don't always doesn't always mean that they have put some of their own money into the fund. You can have operating partners and venture partners, which are kind of similar roles. They source. In some cases, they're paid by the fund. In most cases, they have some share of the carry that the fund generates, particularly in deals that they source. So they'll go out and look for companies. They will, take on board roles, support companies. In the case of operating partners, they may have some sectoral expertise, or they might be marketing experts or tech experts, etc. And so they'll dig in with portfolio companies as well. Then depending on the size of the fund, you might have principals or VPs. A lot of US funds have vice presidents instead of principals, and then associates, analysts, etc. I hear a lot of founders saying they don't want to talk to analysts or they don't want to talk to associates. I think that's a mistake. I think you should be open to having lots of conversations with different people. Early stage funds, associates probably have a disproportionate influence. Obviously, if you're talking to a growth stage fund, it's a little bit different. But if you're talking to a 4 or 5 person team where there's 2 associates and two partners, those associates are going to have they're going to have a seat at the table as well. So I wouldn't rule out talking to folks like that. Likewise, principals. In many cases, all of these people sit in the investment committee, which is on the right hand side here. So the investment committee is how VC funds make decisions. So all of the partners or all of the decision makers within the fund get together to look at the deal that is coming in, or the deal that they're proposing to invest in. Different funds have different ways of doing this. Sometimes the company comes in and presents and the partners ask them questions. Most of the time, the partner who's leading the deal, so the GP or general partner who's leading the deal, will present the deal on behalf of the company and then answer questions on behalf of the company, and then they vote. Most funds have a kind of majority consensus or a majority that you have to get to. So 3 out of 4 partners, or 3 out of 4, 2 out of 3 members of the investment committee have to agree to the deal. Some have full consensus. So at Terra, everyone has to agree to the deal before we'll do it. And this depends on the fund, right? Some funds have enormous investment committees that have advisors sitting on it, etc. But I imagine most of the people who are here today, you're early stage, so it will be kind of a 3, 4, maybe 5 person investment committee. And as I say, maybe you'll get to pitch, or you'll rely on the VC who's leading the deal to not make a mess of it for you. And just then, in general, as I say, the different funds have, or VC funds have different funds that they manage, right? So usually you raise a fund, as I say, you invest for 2-3 years, and you raise the next fund 2, and you raise fund 3, etc., etc. Those funds, in many cases, will have different limited partners. So it is a big deal to try and retain your LPs. So as much as you can, you try to get the same people who gave you money the first time around to stick around, and usually you want them to do that because it's a real show of confidence in what you're doing. And also, it's usually because you've given them some money back, and so you've had some positive outcomes yourself. And then different funds can have different theses, or different focus areas, different geographical focus areas. In some cases, there are some VC funds that operate 4 or 5 different funds simultaneously, but most operate kind of one at a time. And yeah, I think, again, this is one of the more recent examples, similar to George Dorio that I spoke about earlier. The best performing VC fund of recent times is Lowercase Capital. So I think it was an $8 billion fund. If you put 100K in, you would have gotten $25 million back out. So he invested in Uber, Instagram, and Twitter at the very earliest stages in out of that fund. So pretty well performing one, and obviously, if you think about the carry on that, you understand why Chris Sacca, who ran that fund, is a billionaire basically. So that's kind of the rationale behind it. I'm going to very quickly show you how a VC fund pitches itself, and then we're just going to run through some examples in terms of how they would invest, how they view different types of returns, et cetera, et cetera. And again, if you have any questions, feel free to pop them in the live chat. So most of you, I'm sure, are familiar with Product Hunt. So Ryan Hoover, who started Product Hunt, also runs a really good newsletter for VC funds that are raising capital or that are deploying capital. And as part of it, he shared his own fund pitch deck. So as I say, the VC funds have to go and pitch a whole bunch of people in the same way that you do. We have to produce a deck. As you'll see as we go through this deck, it's a little bit different in terms of the order in which information is presented, but a lot of the fundamentals are the same. I'm happy to share this. It's publicly available as well if you want to find it. But if you want the actual full deck, you can just ping me afterwards. So VC funds generally, actually, what you lead with are the people, right? Again, my investment thesis has always been kind of team, market traction idea. In VC funds, it's very similar. You're backing someone and their knowledge, their network, their track record, et cetera, et cetera. So, Ryan started Product Hunt, which was invested in, Andreessen and Y Combinator invested in it, got acquired by AngelList. Obviously knows an awful lot of people. So this is kind of a pretty good mic drop first slide to have in your deck. And then Vedika, who's now based in London and has been an operator, again, worked with some prominent VC funds and with Stripe, which is always a good vote of confidence. They show themselves then. Here's our, almost like our traction, as you would think about it in a VC deck. So, known some more investments with better performance. So being able to kind of show, as you can see, you always want to be in the top right-hand corner of that kind of Gartner 2x2 matrix. But again, showing their performance, talking a little bit about, and we'll talk about these acronyms now in a couple of minutes, but talking about the performance of Fund 1 and 2. So 84 portfolio companies, 3.26 TVPI, Fund 2, which is the more recent one, 2.73. So both pretty good numbers. There is one detail that they don't include here, which again we'll talk about in a few minutes. That is a really critical metric for VC investors. And then a little bit on the kind of history of the fund. This again, all VCs want to be able to demonstrate that they have deal flow, ideally proprietary deal flow or earlier than anyone else deal flow. So, being able to say, look, Ryan started Product Hunt, a lot of people are going to come to him, right? They're going to see hundreds, maybe even thousands of companies a week launching on there, getting in there, getting, people reaching out for advice, et cetera, and getting a great reputation. And then all of the kind of, nice metrics around how many followers on LinkedIn and Twitter, and anyone remember Clubhouse? Here are some deals that we did. Here's the kind of timeline of meeting the companies. Here's the way that we converted in the case of Main Street, like, hey, not sure about them, but actually we kept in touch and then decided to make an investment. And look, then they raised a huge round from Signal Fire. So it's all of this is kind of showing like founders want this fund on their cap table. Here's what founders have actually said about us. Here are some of the introductions. So in the case of Deal, like, we introduced the founder to Andreessen. They led their Series A. We were able to kind of get in touch with them because of Product Hunt, et cetera, right? So this is all very powerful stuff that limited partners want to see in terms of winning deals, getting early access to deals, et cetera. And then the blurb from founders themselves, our NPS score. You see a lot of companies, a lot of funds, I should say, now using NPS scores. It was one of the handful of things that could get you fired at Techstars was if your founder NPS was too low. So if you ran a really crappy program and everyone said, hey, Eamonn's an asshole and this was a waste of time, that was one of the things that would get you called to the headmaster's office, as it were. So this is, again, not every LP or investor will look for it, but it's something important to have. And then again, some surveys that they've done in terms of different types of companies, a little bit of detail on their investment focus and thesis and how they work. a little bit on their performance. So we make lots of introductions to other people because we know all of these other investors. So every VC fund that has ever pitched will have a wall of logos of the co-investors in deals that they've done and the introductions that they've been able to make, etc. There's some stuff that's kind of redacted here, but I mean, you get a picture. Fund one was 3 million. They did pretty small checks. They didn't do any follow-on investing, so they just wrote one check into a company, and then they never did a follow-on round. Fund two, bigger check size. They reserved a bit for following on in companies, and then fund three, they're raising a bigger amount. They're going to put in a little bit more money, not tons more, and they're going to reserve a bit more of the fund for follow-ons. And you'll see why in a few minutes. Most funds reserve money for follow-on investments because you want to back the winners. You want to maintain as much ownership in the really big companies that you back as possible, particularly if you're coming in very early. If you're the first money into a company that goes public, there might be, if you're very fortunate, 4, maybe 5 funding rounds in which you'll get diluted. If you're unlucky, there might be 10 or 15, and some of them might be down rounds where you get almost wiped out. So follow on capital, we see a lot of LPs being interested in how much of that we're going to reserve, because they obviously want us to follow the winners. And again, that'll inform some of the stuff that I'll talk about a little bit later on. So again, this is just some of the detailed kind of management fee to 2-year investment period in their case, and then some of how the management fee is kind of being structured. I won't go through this in too much detail, but they also, like LPs, like getting updates from the funds that they invest in the same way that your investors like getting updates from you. So that's important. Follow-on investments, again, I think this is important to think about, and it's an important question for you to think about as well. You should be asking VCs when they're talking to you if they have reserves to follow on, or if they will participate in future rounds, because obviously what you want is your pre-seed lead investor to participate at minimum in your next round, because it looks really bad if someone's put 1 million, or 500,000 euro into your business, and then a year later they're not going to put any more in, and they're going to let someone else take all the risk. There's some negative signals there. I'm just leaving this on because this shows you the kind of the fee structure, right? So management fees, they front load them in the first 3 years when they're investing, and then the management fee goes down and down as they are no longer actively investing the fund. So let's play make believe. Just a question from Bida. Sorry if I'm getting the pronunciation wrong. How often do VCs use safes or notes versus straight equity? Oh, hi, Tom. Sorry. So I'll give you the annoying VC answer. It depends. I think a pre-seed, most people would be pretty happy using notes or safes. I think once you get to seed, and pre-seed rounds in general will have just a bunch of people involved, right? You might have one lead VC investor who will put in, let's say it's a fictitious 750K pre-seed round. You might have a lead investor who's coming in, they're going to put in 500K, and then you'll have like 8 to 10, maybe even more angels and friends, and maybe a syndicate that'll put in anything from 10 to 50K. And there it's usually easiest to structure it as a note. When you get to your seed round, then the lead VC in that round might go, actually, let's just tidy everything up and do a priced round. But again, it depends on the fund. Like the last deal that I did, we did a priced round, led a priced pre-seed round. But we've also done like a bunch of convertible notes. The challenge, obviously, with notes is a lot depends on the funding environment. So what you don't want to do, like it is taking longer for companies to raise. So it used to be that you would raise enough money for 12 to 18 months. Now it's like you need to raise for 18 to 24 months. And obviously, if you raise for 24 months and the maturity on that note is 24 months, then there's interest that's starting to accrue, and so there's more, like, this is not like huge differences, but you're losing a little bit more equity in the business as time goes on. So in some cases, there's a preference for price rounds, but in general, notes are quicker and simpler and easier. And usually, if you're raising 500k or 750k, it's because you don't have any money at the moment, and so the priority is on like, can we just get this done daily, quickly, get money into the account so the companies can actually pay themselves, the founders can pay themselves, and then they can crack on. So yeah, any more questions, please feel free to type them in the chat, and I'll do my best to answer them. So let's play make believe. This is the fiction fund. The fiction fund is a $100 million fund. It invests $10 million into each company, and in every single case, it gets 15% ownership. Amazing, right? This is the dream. Let's look at a couple of outcomes for those companies, right? So they're investing in 10 companies over the lifetime of the fund. There's no follow-on or capital reserved for those businesses for their next round. But miracle of miracles, every single company in that portfolio exits for $50 million, right? So you would have, there's a slight mistake here. But every company exits for $50 million. The VC would then be getting about $15 million on each one, so about $150 million return. So the VC fund in this case would probably have a profit. So if you think about that hurdle that I mentioned earlier, they need to return 1.2x of the fund, so 120 million. So there's 10 million profit. They get 20% of that, so 2 million. So it's not the worst outcome in the world for the VC fund, right? They've made some profits. It's gone pretty well. This fund would probably not raise another fund afterwards with this performance, right? This would be viewed as very poor performance. 1.5x return, not amazing by any stretch of the imagination. If you have 5 companies that sell for 50 billion and 5 companies that sell for 100 billion, you don't net out actually dramatically better. You net out about a 2x return, so about 100 and a little under 200 million of a return. So still 2x. You would at least have meetings for your next fund, but it would take a long time to close. It wouldn't be viewed as being like a massive success. If you have 5 companies that sell for 50 billion, if you have 4 for 100 billion, 1 for 500 million, okay, now you're knocking on the door of a successful fund, right? Now you're over 3x. But this is not a likely outcome. Again, if you have 1 star, so 9 companies exit for 50 billion, 1 exits for a billion, okay, you're again in the 3x territory. It's not so bad. But much more likely is actually that you don't have very many that exit at all, right? You have 5 companies that go to 0. You have 2 or 3 companies that maybe exit for 10, 20 million. You have 1 medium outcome of 200 million, and then you have $1 billion outcome. In that case, again, you're returning a 3x fund, a little bit over 3 point something. But it just goes to show you that, like, actually, even if companies sell successfully, it's not always a success for the VC fund. And let me give you an example of it, right? So some of you may have heard of a company called Gorkana. It was a media monitoring company. It came out a couple of years ago. So they raised 4 rounds of funding. So a kind of C to Series A, Series B, and Series C. This is a couple of years ago, so you'll understand why the numbers are look kind of crazy low. But they took 10, raised 100 million on a 1 million pre-money, so post-money 1.1 million. So they were diluted by 9%. You see then they do this Series A. I'm sorry, I should say these are the founders. So the lower number here, this is the founder equity. Higher number here is the seed round equity. So they then raise at a 3 million valuation, a 15 million valuation, and a 60 million valuation. So the company exits for $200 million, right? Which is pretty good outcome, right? Like what we would consider a medium case. But if you look at the share of that, right? So this is an amazing day at the office for you as founders, right? So 2-3 founders, you still own a quarter of the company, basically sells for 200 million. You're walking away with 25 million each, right? Amazing. You're not going to have to work again. You can whatever, buy yourself a Ferrari and a walk-in humidor if you want. If you look at, and this is the interesting part, right? those seed investors who put money in, yes, their share is kind of the value of the company is increasing over time, but their little slice of it that you can see on the far right hand side, is decreasing. So they go from owning 9% of the company after the seed round to owning less than 3% of it after the Series E. So if we go back to this slide, those seed investors, okay, it's not the worst day at the office, right? They've made a bunch of money, but it would not be viewed as a terribly successful outcome. Likewise, the Series A, B, and C investors, you're going to have some people who are happy for a minute or two, and then we'll look at these numbers and go, okay, yes, we had a 54x return, but if I am a $50 million fund or a $100 million fund, this is not moving the needle for me, right? This is not getting me closer to generating that carry that I want. If I'm a Series A fund, I'm much more likely to be 150, $200 million fund. Okay, not the worst day at the office ever, but still, not a big winner, right? And that's why I say this will be considered a medium outcome, even though for the founders it's like a life altering one. You're not a fund returner, right? And that's ultimately what VCs are looking for. And this was an example that the guys from 7% Ventures shared this recently, and I thought it was a brilliant example of how VCs think, right? So, thank you for considering us as a potential investor and sharing your vision. What you're building seems interesting, but it's a pass for us. We're not sure from your deck how your startup gets to be a multi-billion-dollar company. A market size of 9 billion mentioned in the deck is great, is big enough to build a great business, but it's not a fit for the 100x or 200x we need for our own model to work. We recognize there are an opportunity to extend into other markets. However, we are not sure to what extent it will be possible. Other angels and VCs may be happy with your GTM and market size, but this is not a criticism of your business, more a commentary on our approach. So this is a very rare example of a VC actually being honest, right? If you think about a $9 billion market, I would think, okay, good. But actually, if you want to be a company turning over $1 billion a year in revenue and worth $10 billion, you would need to capture a double-digit percentage of that market, which seems unlikely, right? Which might be very, very challenging for a whole bunch of different reasons. And I very regularly get pitched by founders who are going, "Hey, I'm building this business. I think we will get it to 10 million in revenue in the next 5 years." That is brilliant if you're pitching me as an angel investor, but a business that's turning over 10 million in revenue in 5 years' time is probably going to be worth maybe 60 or 80 million in an exit. And so, again, if I think about returning my fund, I need that to be an order of magnitude bigger in order for you to be a fund returner investment. And so I will pay less attention to that deal than I will for one where I'm like, oh, actually, we're going to get to 300 million in an enormous market, and here's our unfair advantage, et cetera, et cetera. So you really, really need to think about how you are pitching and what you're showing in your financial model. There's been a whole argument on Twitter and LinkedIn over the last while about whether companies should have financial models. In general, I think they should. I think it's a good kind of hygiene piece and a good thing to do, more to show me how you're going to spend money actually than anything else. But I also do want to know that you understand what we as VCs need in terms of revenue after 5 years, in terms of growth rates, in terms of revenue that you need to get to your next round, et cetera, et cetera. I don't have a ton of slides left. We've got about 9 to go. So if you've got questions, feel free to fire them in. But there's a whole bunch of stuff that you need to be aware of, because VCs are praying for very, very large exits, right? And they can't always show those. So VC funds raise every 2 or 3 years, and mostly they don't raise based on returns, because it takes, the really big companies, it's going to take 8, 10 plus years to generate a return. So they raise based on TVPI, which you saw in the weekend fund deck, and DPI, right? So TVPI is total value to paid in capital. So investors have put in $30 million out of a $50 million fund, and that the value of those the value of those companies has increased, and now that investment is worth 60 million. That's a 2x DPI, right? So 30 million has been deployed. That 30 million is now worth 60 million. Amazing. DPI is distributed value to paid in. So that is how much money have you returned to investors, right? So it's a $50 million fund and you have returned 5 million. That is, 0.1%. It's $50 million fund, you return 50 million. Okay, it's a 1x fund. One DPI is 1. Usually you can't move the needle on DPI, right? That requires someone to buy a company or for a company to IPO. So mostly companies rely on your valuation increasing rapidly. And that means that if you raise money from a VC fund, as soon as you raise that money, they are going to want to know that you understand the milestones that you need to get to your next round. So if you raise if you're pitching me for a pre-seed round now, you need to be able to very quickly show me that you've got a path to ideally high hundreds of thousands in annual revenue within a kind of 12 to 18 month time period, because I've got a pretty good picture that says, hey, if you're doing less than 20K MRR, you're probably not going to raise your next round of funding, or certainly going to be very difficult, or it will be very flat. If you're raising a seed round and your next round is a Series A, you need to show me a clear path to 2 million in annual revenue within that kind of 12, 18, 24 month period of time. Because again, that is what the Series A funds now view as kind of like table stakes for doing a deal. And if you can't show me those things, okay, there are still lots of deals to get done without necessarily those milestones being there, but it's much harder. And if you're showing me, again, I get pitched by companies all the time. They're like, we're going after $1 billion market. You go, okay, great. Like, that weirdly is a very big number, and you can build a very successful business. But if I think about the likelihood of you being a fund returner in that market, it's nil. Like, unless you get 100% of that market, and we own, 20% of your company, or 10% of your company, it's not gonna move the needle enough. And so again, it just it can run the risk of making VCs go, I'm just going to go and move on to the next deck, because that power law that I showed you for funds, right? Like the top 6% of funds deliver the majority of returns. That is true for startups as well, right? So like maybe 3% of companies will reach 100 million valuation. A vanishingly small number of companies will get to a $1 billion valuation. The majority, unfortunately, just don't work out, right? And there is data up the wazoo out there that show the kind of graduation rates from seed to pre-seed to seed to Series A, et cetera, et cetera. And the numbers are they make for sobering reading, because it is very, very hard to raise follow-on rates. And it is especially hard at the moment. Pre-seed and seed, yes, there are deals still being done, actually quite a few of them. But that kind of jump from seed to Series A is super, super difficult at the moment, and certainly not showing any signs of getting easier. And the risk that you have as founders is that you end up like in this position where I, as a VC, am looking at this going, is this a bridge to greener pastures, or is this a pier? And we're just going to all walk off it together. Because if it feels like a pier, you run the risk of being one of those companies that's kind of in the long tail, right? So one of the companies that the VCs go, it's unlikely this is going to get to an outcome in time for us to be able to kind of make real money on this business. And so what we're going to try and do is, in some cases, we're going to try and install a new management team. In some cases, we are going to try and sell the company either for some money, or more often than not, we're going to try and sell this for parts. You see companies going through pre-pack bankruptcies. You see companies going through recaps and starting again and trying to raise fresh money in. And we can talk about the pros and cons of all of those in the Q&A if anyone wants to. But you will start to notice it as a portfolio company, because it's like, hey, you suddenly don't feel the love quite as much. So you feel like sometimes the company can get deprioritized a little bit, and that is a risk. Now, it happens. Listen, some VCs are just very busy, and some. I mean, I subscribe to the view the way that my mum learned how to swim was she was kind of repeatedly dropped out of the side of a boat until she learned how to float, and then you learn from there, which probably explains why she's terrified of boats. But I've taken a similar view with portfolio companies, that like they have my WhatsApp, they have my details, and they tell me what they need and when they want to chat, and I'm there. But you certainly can start to notice, and we have seen this with companies that have raised from bigger funds, even companies that have raised Series A. You stop getting invited to maybe the best party or the best event, or your board meetings that used to all be in person suddenly start happening virtually, and they're shorter, and they're only once every 6 months. And you can end up getting deprioritized because if you think about this and you're the VC fund looking for that carry, you're going to put a disproportionate amount of time into the one or two companies in your fund that have the opportunity to deliver that to you. So it can be very, very risky for founders who take money and end up in that kind of middle tier or in that kind of long tail because all of a sudden, all of the promises, everything else that funds have done, they just don't deliver that because they're focusing all their energy on making sure that the biggest and best company gets to that billion or 2 billion or 10 billion valuation. So yeah, choose your investors wisely, right? Do you want an angel? Do you want a VC? Do you want to do revenue? But I mean, what we're seeing a lot now, and again, we can talk about this in Q&A. We are seeing a lot of companies who raise a pre-seed round, build a business, don't hire tons of people. They're able to kind of manage their costs pretty well. I get to the point that they're doing, 20, 30, 50K in revenue every month. And then they go either to, uncapped or one of the other revenue-based financing, or they find debt providers, small venture debt providers, family offices, other people who will kind of give venture debt type deals and terms. And they will never raise a seed round. They will just go, they'll maybe never even raise any more VC money. They will just kind of use the growth of their company and growth in revenue to fuel the growth of the business. So there are other options out there, which again, I'm very happy to discuss. But yeah, as I say, choose wisely because you are stuck with your investors for a very, very, very long time. The average time, as I say, from startup to IPO is like 10 years. Average marriage in the US lasts for 6. So you are stuck with these investors for quite a substantial period of time if you're not careful. So that's my email address if people want to get in touch with me afterwards. And obviously you can message me here and everything else. I'm going to stop sharing and you will see my face appear on screen again. And then I'll answer any questions that you have. So Christopher, what happens if a fund has used up its 10 plus 1 plus 1 time frame, shows decent TVPI but hasn't realized any DPI? This is a very good question. What normally there are like 3 outcomes, right? Yeah, but basically 3 outcomes. So the most likely one, the one that happens the majority of the time, is that the LPs in the fund will go, you will like basically harvest this fund in 2 years. So find someone who will buy your stake in these businesses in a secondary transaction, or find there are funds out there that will just buy out the whole fund, return capital to the investors and let the and then they'll manage it kind of going forwards. But more often than not, what ends up happening is the LPs will say, you don't get any more management fee from us. You don't get any more expenses from us. You will continue managing this and you will exit. If it starts to drag on longer and longer, they will then start to add more punitive terms saying, hey, you now have this period of time to exit. If you don't exit by here, then your carry drops from 20% to 10%, from 10% to 5% to nothing. So there are very punitive terms that can kind of come in. So as I say, more often than not, the funds end up continuing to manage it for a period of time. They, as I said, then they can sell to secondary funds. So they can sell their position in individual companies. Usually at the moment, the discount is like 50%, maybe up to 60% on the valuation of the last round. So the fund ends up taking a massive haircut. So let's say I have a stake in a company that's worth 10 million and I want to exit it. I find a secondary fund that says, yes, we love this company. We want to own a bunch of stock in that company. I'll give you 5 million for it. And again, depending on your relationship with your LPs or others, you may have to go, okay. And then the other similar version of that is there are funds who will come in and buy out the whole fund. So they'll just go, look, we'll pay, your fund is at, let's say it's 5x TVPI, right? This looks pretty promising. We will pay your LPs out at 2.5x TVPI, and you can continue and manage a bit of the fund, and you will still get some carry or some upside if you maintain board positions, et cetera, et cetera. So there's some incentive for them to do it. You do sometimes see like in some cases, it's very rare, I would say, that this happens, but in some cases the fund it's like the fund is going to close down. In some cases they return the equity to the founders, or they'll do basically a fire sale, like the founders can buy the stakes back for virtually nothing. It's really rare that, or other investors can buy the stake for virtually nothing. It's very rare that happens, just because it tends to be kind of materially damaging to the companies if it's like, oh, your shares have been sold in a fire sale, and yet you still want to go and raise money from someone else. You do see, like, with company, with funds that have been going for a long time, where they have a couple of companies that are pretty successful. Um, in many cases, the founders of those companies will go, "Hey, I want to buy your share in my company back again as well." So they'll either sell the portfolio off for parts, or as a whole. And it's tricky, right? There's a school of thought that says that, if the Vision Fund in particular had been like a 20-year fund or a 25-year kind of period, actually the outcome would have been materially better, right? If it had been more patient capital rather than this kind of VC, we need the outcome very, very quickly. And that's the case of, I mean, fans of VC may have seen this week that, like, one of Sequoia's funds bought secondary shares in Stripe from other Sequoia funds. So again, Stripe is taking a longer time than would normally be the case to go public, for a variety of reasons. And in some cases, I guess LPs in the Sequoia fund that invested in them, maybe going, "Hey, actually, I wouldn't mind buying a new castle somewhere. Can I get some liquidity?" And so, this other newer Sequoia fund has come in and bought secondary from them, not at in that case, not at like some haircut kind of discount. I think they bought it at the last round's valuation, or maybe fractionally lower than the last round. So yeah, it's a challenge because companies do stay public, or sorry, companies stay private for longer, and so it is harder for VC funds to return money to their LPs. Again, there is a myth that, like, VCs are kind of all powerful and can tell you what to do. I mean, anyone who watched the WeWork whatever show on Apple TV will know that that wasn't the case. VCs advised the company on what they should do, but the founders took it in a different direction until they couldn't. So, I think it is a challenge for funds at the moment. Like, I think candidly, a lot of the funds that are out there at the moment, I would say 20, 25, maybe even 30 or 40% of them won't be knocking around in a couple of years, because it will be very difficult for them to return 3x to their investors. And that's why you see, like, again, there was a statistic that came out a week or two ago that, like, 80% of the LP investment into VC funds so far this year, or maybe even over the last year, was into either Andreessen or General Catalyst. So, kind of Pareto law of some description. So the funds that are not returning are just not able to raise new capital. And actually, even the LPs who are interested in investing in VC funds, because they haven't gotten any money out of the investments that they've already made, they're kind of going, well, if I, and that's why I said LP retention is important. Like, if I put 100K into a fund and I get, 200 or 300K back, I'm much more likely to put another 100 or maybe even 200 into the next fund. If I put 100K in and I get 50K back, then I'm almost certainly not, unless they're my best friends. And even then, I don't think I would do it. So I think there are big challenges for a lot of funds that are out there as a result. And if you look at family offices and corporates, because public markets tanked so much, instead of having 2% allocated to VC funds, their overall portfolio value has declined by like 10 or 20%. And suddenly it's like, oh, we have like 5% exposure to VC. Like, that's way higher than we want. Anyway, these are the kind of minutiae of VC deals. Tom, as general knowledge term sheets widens, do you think terms become more standardized, or they're still good or bad ones? They're much better, much better. And part of that is, I think, standardization. So you have, like, the Seed Summit documents that Seed Camp and others did in this part of the world. You have SAFEs, obviously, that YC did. So there is more standardization that people can point to. There are more communities. If any of you are on, like, Landscape's founder community, like anonymous founder Slack, you can share terms, or you can share terms or details on there, and someone will tell you if they're good or bad. So there's a lot more knowledge about what good and bad looks like, which I think is a massive positive overall. I still see, like, unbelievably shitty term sheets regularly, very regularly, unfortunately. In many cases, they're from, more, I kind of hate the word emerging markets, but they're from markets where like the angel and VC ecosystem is less developed, right? There are fewer VCs and angels, and in some cases, and this is me being charitable, I think actually people are not necessarily doing it because they're bad actors. They're doing it because their lawyer said this is what you should ask for, or their lawyer watched Dragon's Den and said you should ask for 60% of the company instead of 2%. Um, and so they just don't know what good looks like. And then yeah, there are a lot of cases, sadly, still where there are bad actors. I saw a conversation online the other day about someone who was raising, I think it was 50K from or they had a term sheet from a fund for 50K, but the fund wanted 5K, the company to pay 5K first to pay for the due diligence expenses of the fund, and then they would send them the 50K. Like that's a scam, right? Like if that's happening, that's not how it works. So there is still a lot of bad behavior out there. I am my inner optimist, and the kind of whatever part of me inside that still believes in humanity likes to think that a lot of it is just investors aren't well educated or don't necessarily have great role models where they are, or great knowledge or network or understanding. But yeah, there are still some terrible people and bad actors out there, I'm afraid to say. Uh, if I was joining as a co-founder to a startup today, what would I request on the cliff investing? Interesting question. Again, topic of no small amount of conversation in the last couple of weeks online. So generally, what we required at Techstars was 4-year vesting with a 1-year cliff for founders. And for the most part, that has worked. We have, unfortunately, had instances where after 1 year or 2 years, a founder has not worked out, um, and they have left mostly voluntarily, occasionally involuntarily, and because docs were not created properly, bad lever, things were not created properly, etc. You're left with maybe 9, 10, 12, upwards 20% of the cap table owned by someone who's not involved in the business anymore. So we are starting to see some conversation around um, kind of reverse vesting. So 4 or 5, maybe even 6 or 8 years. I've seen some people suggest, but backloaded in terms of the massive kind of equity kicker. So you vest tiny amounts per month up until either there is like an outcome, so an M&A or IPO, or until you get to 8 or 10 years, and then you're fully vested. And obviously, you can add in um, triggers and accelerators and all sorts of things that say, hey, if someone gets sick, then they have to leave. Then we have this scenario. If someone has to leave for family reasons, then there's this scenario. So I think it's a really interesting, like it's a it's a super interesting conversation. I would love, and I suspect it will happen at some conference over the next little while. I'd love to get a bunch of smart people in a room and kind of map out what fair looks like, a little bit like safe documents, or safe docs, or notes, or seed summit docs, etc. To go, okay, this is what we think is actually good and founder friendly, um, and sufficiently structured in a way that it can't be abused by an investor or a third party, but where a founder comes in and only lasts 2 years, and maybe isn't the right person to take the business forward, like for that person to then leave and have a really big chunk of the business, 25% of their equity already vested. That is tough, and that can kill company. I mean, I've seen it kill companies. um, Alicia, it sounds like it might be more interesting to stick with angels at pre-seed stage. An annoying VC answer: it depends. I'll put it like this: if I were starting a company today, I I would probably try to raise from like maybe a couple of syndicate funds. So, I mean, in the UK, like the folks from Ventures Together or FFF.VC over in the Nordics and Baltics, you have Everywhere Ventures, obviously, where I'm involved. Angel Invest, a couple of other people who, they would do something from 25K up to 200K, largely run by former operators and founders. You get a bunch of people around the table. You join a community. There's a bunch of good learning to have by being part of it. Good support. Um, and maybe a couple of angels that were specific to the kind of industry or business that I was trying to build. Um, you know, and in the UK that's a little bit easier because there's a tax incentive scheme for angel investors. But I would probably go, hey, yeah, you want to raise like pre-seed, like somewhere between 500K and or thereabouts, maybe a little bit more, um, and and don't have that pressure to immediately start thinking about your next round because you raise 1 million, let's say, and 750 of that comes from a pre-seed lead investor who then owns like 12% of the company. You will start to get questions pretty quickly about like, oh, you should talk to like this person at this fund for your next round, which will be 2 to 3 million, and it needs to happen in the next kind of 6 months. Um, so that's the risk if you can raise from angels. But I would try to over index on angels or syndicates or communities or groups that can add disproportionate value. A little bit like the weekend fund deck that I showed you, right? Like you get money from them, but like Ryan knows everyone, right? Can I have an intro here? Yeah, okay. That's what you want. And these kind of syndicates or groups are useful. And if you're a first time founder, by the way, I would like 100% do an accelerator. And this is not a ad for Techstars or anyone else. But I think what you learn doing a really, really good program, even for the amount of equity that you give away, is like disproportionately valuable if you're a first time founder, because you have so much stuff that you need to learn and figure out. Learn it based on other people's mistakes rather than making them all yourself. But yeah, I would probably go more for those angels and kind of micro funds. And maybe if there's a fund that or that you like or that you admire, I would say it's no harm to have a conversation with them, right? Worst case scenario, they say no, but you've at least had a conversation with them, and they might be a great investor for your next round. Um, oh, hey Pamela, is it a good time to invest in secondary funds now? Yes, I think is the short answer to that. Um, I think if I were starting a fund today, it would be more than likely a secondary fund, just because I think there are a variety. Well, there are a variety of reasons why, right? There are angels looking for liquidity. There are VC funds looking for liquidity. I think there are opportunities to get stakes in brilliant companies at a let's call it a reasonable price, and not do it in a sharky, horrible way, but at least in a kind of medium sharky way. Uh, but yeah, secondaries, I think there are huge, huge opportunities. And to be fair, like there is a lot of activity in the space. I'd say there's at least another half dozen secondary funds I've heard of even just in the last 6 months, and probably even more that are nowhere near my. And that's like it's not like I kind of have a Google alert set up for secondary funds. Like that's just literally someone I overhear it, or someone kind of mentions it in passing, or more often than not, I'm on the internet too much and read about it. So hey, thank you for the folks that have stuck with this. I very much appreciate you sticking with a long rambling presentation. It's a bit much for one person to speak for whatever it's been, an hour and 8 minutes. But I got time for one or two more questions if anyone has them, and if not, I will drink some water. Maybe reward myself with a glass of wine downstairs. Okay, I will take that as a sign from the heavens that you all have had enough, and it is time for me to go downstairs and give you a break from my monotonous voice. I really appreciate everyone tuning in. As said, one of the benefits of being called Eamonn Carey is it's very easy to find me on LinkedIn, on Twitter, or X, whatever, and various different places. My email address was in the presentation earlier, so it's just eamon@terra.vc. So if you do have questions or queries, or if there's anything, what's always the case with these things, like 10 people have the same question, but they're all embarrassed to ask it. So feel free to pop it across. I'll do my best to answer it on, as I say, LinkedIn, Twitter, elsewhere. But otherwise, have a lovely rest of your Thursday afternoon, evening, or night, depending which part of the world you're dialing in from. Appreciate you tuning in, and I will hopefully chat to some of you very soon. But otherwise, have a great evening and a brilliant weekend ahead.